quick as I can on all of them and flip through each of the stocks and see what reactions we're getting. But it is going to be a pretty big day for the equity markets. Just remember, regardless of what happens up or down, we are all winners for actually caring about trying to achieve some level of financial freedom by allocating capital. It's not something that everyone does, but the fact that we're all doing it is very, very special. Thank you, everybody, for being here. Wednesday, October 29th, 4 p.m. The stock market is now closed. All right, here we go. Palantir, all-time high, 198.83 on the close. Robinhood at 144. Tessie at 461. NVIDIA's up 3%. S&P actually closed green. We closed green, even with that whiplash from JPOW, 687.72 on the S&P 500. SoFi right there, 30.87. Reddit closed green on the day. Amazon up 0.5%. Grab 185.605. PayPal was down 4% because of Fiserv going down 40%. Salesforce down 1%. Apple basically at all-time highs at 269. SMCI up a little bit on the day. Ethereum slightly down, 3,900. Then Bitcoin, 110.6. That was also a bit down on the day. We should be getting earnings pretty much in the next 30 seconds. Googs, do we have a mover on Googs? Let's see. Googs tends to be earlier before the other two. She's moving. She 276. I think, yep, there she's moving. All right, we're going to see. I will get the numbers as soon as I can. And we're going to see what we got. Googs usually happens immediately. Microsoft and Meta a little bit later. We do have ServiceNow. We have Starbucks. We have Chipotle, Mercado Libre. I don't see any crazy new moves after hours. We got to pay attention to NVIDIA as well as we're looking at all these companies. Teladoc, eBay, KLAC, another semiconductor name, and then ServiceNow and software. Mercado Libre is up right there, and then Starbucks, that's down. Google, 276. You're getting a bit of a candle, nothing too crazy. But the numbers are not in yet. Yeah, S&P did go green. S&P did go green on the close. Falling Knife, thank you for the $200 super chat. You did not need to send that. Deeply, deeply appreciate you, man. Thank you for being here, and thank you for the super chat. Also, Muckabee, thank you for the super chat as well, man. Just for being here with me. Couldn't do this alone. Appreciate you guys. I'm just very happy that people chose to be here all day with me, and we got to do this together. So thank you all for being here. Googs, 280. All right, we're getting the move. We're getting a move. 280, 281, 282, 283, 284. Oh my goodness. How big of a beat was this? How big? I don't have the numbers yet on Googs. I don't have it yet. I don't have it yet. Street's got to like it for a 280 move. 282. Street's got to be happy with it if they're giving it that much of a move right now. Let's see if I can pull this up. I got Mercado Libre numbers. It looks like a beat and a miss for Mercado Libre. Don't have Google yet. 281. She's holding 280. Again, the stock was stuck at 150 for like 9 months. So this is a big one. Oh my goodness. 26% beat. Oh my goodness. 287 versus 227. That's almost a 30% beat. Revenue 102 versus 100. That's a $2 billion beat on revenue. Google's at 285. Google is at 285. It looks like she wants $300 end of year, maybe earlier than that. My goodness, 26% beat for a $3.2 trillion company. That means
that's pretty insane.
Completely underestimated what Google would put up.
Let me pull this up.
Microsoft and Meta I don't have yet, but Google just making a massive move right here.
Yep. Oh, my.
285 still moving. There you go, 284. Wow. Microsoft's dumping. Are we actually dumping? Microsoft is dumping. Microsoft is dumping. Microsoft is down 4%. Wow. Google go up, Microsoft go down. Let me see Microsoft numbers. We'll get into the specifics of everything in a second. Mercado Libre, by the way, they missed by 11% on EPS. They beat by 3% on revenue. Mercado Libre is also down, not down like crazy, but they are down. Google just hit 289. Google just hit 290. Google just hit 290. Microsoft just hit below 520. Oh my goodness, dude. Up and down. That is quite incredible. EPS on Microsoft. I think I have it. Do I have Microsoft? Let me see. Do we have it? Yeah. Okay, they beat by 13% for Microsoft on EPS, 413 versus 366. That's a beat. And then revenue 3%, 77.6 versus 77.5 or 75.3 billion. EPS is up 20% year over year, 25%. Revenue is up 18% year over year. Street doesn't like it. Street loves Google. 295. Oh my goodness. Guys, this was at 150 for 9 months. If it goes to 300, that is a double on a $3 trillion company in less than 4 months. Forget less than 4 months. This started moving closer to September. It's less than 3 months. 292 on the Googs, hit 295. Microsoft, this is not a bad number on Microsoft. 13% beat is not something to scoff at. I guess the street thought, they could get a 20% beat like Google, 77.6 versus 75 billion on revenue. Meta, let me see if I have Meta. Meta's dumping. Oh boy, I kind of had a feeling about Meta dumping. Kind of had a feeling about that. There you go, 728 on Meta. Let's see Meta's numbers. Don't have them yet. Should be getting them in a second. Meta.
Do they say CapEx in the earnings calls? Oh, wait, no, that should be on the sheets.
Yeah, and I'll get the sheet in a second to see. Meta. Hold on, there's no way these numbers are true. I got to be looking at something crazy. I'm looking at some weird numbers. There's got to be. The numbers I'm looking at is looking like they missed EPS by $5. There's no way. Now, granted, the stock's down heavy right now, so maybe there is a way. Meta right there, 708. Goodness gracious, bro. This one just getting wrecked. Google's 300. Did we hit 300? I didn't see that. I saw 295, not 300. Meta 706. Meta and Microsoft getting hit. Google going up. I'll try to get the Microsoft numbers in a second, or the Meta numbers, but let's get some coverage real quick on Microsoft, and then let me get the Meta numbers right here. Let me pull this up right now.
From it being at a discount valuation-wise to the likes of Microsoft and other comparable names. So I do think that's why you have that positive. And then, the revenue acceleration in cloud, as Stephanie was saying, is something that is going to tell you that we can still tolerate the higher CapEx.
Guys, I think I was looking at the right number. What? Either this is false or an 84% miss on EPS for Meta? What? I guess I was looking at the right numbers. 105 versus 667. 51 billion versus 49 billion. This has to be an accounting thing. This has to be accounting. This has to be they're taking off a charge off, or they're engaging in a charge off. Goodwill impairment. There's no way. Or if this is legit and it's not accounting, which I really do think it's accounting. If it's legit, that means they're spending a ridiculous amount on labor and it's screwing their margins, but there's no way it's screwing it by 84%. Like, that makes no sense. But that's what you are looking at right here on Meta. Chad says they're writing off scale this quickly. We're laughing at that, but theoretically, that's what a miss like this implies, that they're taking off a massive loss on their investments. In this case, they put 15 billion into Scale AI. Maybe they're not getting the ROI right here. 695. We need some more details on what's happening with Meta. GPUs. Okay, but they've been buying GPUs for 4 years. Sam, go ahead.
It says that they expect CapEx for the year, so only one more quarter left, to be 66 to 72, narrowed from previous outlook of 64 to 72. So they expect CapEx to be a little bit higher in the bottom range. CapEx didn't really change. Expect another year of significant capital expenditures, dollar growth in 2026. They don't give a number.
Okay, the reason EPS is down, Meta takes a $15.93 billion non-cash charge on their tax bill. What are they doing writing off $15 billion?
Billion?
No, $15.9 billion.
Billion.
Let's get some coverage on Meta.
Is down 7% or so. Well, earnings and revenue both beat expectations. Adjusted earnings of $7.25. That's ahead of estimates of $6.69. But that includes a one-time non-cash income tax charge of $15.9 billion. But that without that one-time charge, which is due to the big beautiful bill, President Trump's big beautiful deal bill, that would have been an EPS beat. Revenues also ahead of estimates. Daily active people ahead of estimates, 3.54 billion versus 3.49 billion estimated. And the average price per ad was up 10% in the quarter versus an 11% gain that the street account estimate had anticipated. Now, in terms of Q4 revenues, the company is guiding to Q4 revenues between 56 billion and 59 billion. That compares to the 57.25 billion estimated. And they say the outlook reflects an expectation for continued strong ad revenue growth, partially offset by lower year-over-year Reality Labs revenue in the fourth quarter. We're going to continue to dig into this. Does seem like everyone is working.
Did anyone catch what she said? What was in the big beautiful bill that caused this $15 billion? I'm going to listen to it one more time. I got to hear that. I'm still confused why they were able to take that much of it. If they didn't have this, they would have beat EPS by about 10%.
Revenue both beat expectations. Adjusted earnings of $7.25. That's ahead of estimates of $6.69. But that includes a one-time non-cash income tax charge of $15.9 billion.
One-time non-income tax charge of $15.9 billion from the big beautiful bill.
But that without.
Okay, so without that, Meta would be up 698 after hours. Google still moving 285, but it looks like that's the story on Meta, and that's why that's getting hit. Microsoft also still getting hit. Microsoft down about 4% right here. A little bit of recovery, but Microsoft is still down. Jose, welcome.
What's going on, man? It seems like I missed so much already, and it's only been 10 minutes since the market closed.
So Jose.
What's going on, Sam?
Let's get some coverage on Google here, and then we'll try to dive deeper into these numbers as well.
Some more details on that report. Mac?
Hey there, John. So one number that we were looking out for is its full-year CapEx guide. It's now ranging between $91 billion and $93 billion. That puts it very close to the numbers that we've seen from Microsoft and Amazon, the two biggest spenders in that cloud war. They've got CapEx commitments of around $100 billion. It's backlog number, so that's the best indicator of future revenue. That's coming in at $155 billion. Also key here, it's Gemini app, which goes head-to-head with OpenAI's ChatGPT. It's looking at monthly active users of 650 million versus.
Wow. That's a big one. That's a big jump. 650. ChatGPT's at 800.
Is OpenAI's 800 million. I want to bring you that all-important search and other revenue number. This is its cash cow for the company. We're looking at 56.57 billion for that segment, beating estimates of 55.1 billion. We are seeing a miss in its other bets revenue. That's 344 million versus the 433.1 million. That's where its Waymo business lives. One other thing for you I've got, John, is your Q3 YouTube revenue. That's beating estimates at $10.26 billion versus the $10.01 billion expected. And last thing I'll say for you, that cloud revenue growth, that percentage growth, 34% higher from a year earlier to that $15.16 billion as it looks to come up the ranks from that third place position. Back to you guys.
Okay, Mackenzie, thank you. Those shares are up almost 4%.
Jose, any quick thoughts on those numbers?
Did I miss something? Did they increase CapEx? She mentioned 91 to 93 billion. Last quarter we saw was 85 billion for Google. So it does seem like a nice CapEx growth here. So I'm pretty excited about that. So again, just jumping in here, but that was the first thing that grabbed my attention. If those numbers are true, I don't know if they're looking at like, they could be just looking at the next 12 months based on current numbers, or if they actually increased their guidance.
I do think they actually did. She said it came in line with what the street was expecting. So it looks like it's a $5 billion increase. We'll confirm that. But it seems like that is the case. Google doing the best after all these earnings at 286. Meta starting to recover a bit. I still don't know exactly what the big beautiful bill had to do with this $15 billion charge off, but without it, they would have beat EPS and it would have came in at 725. Street was expecting 667. So if they came in at 725, then technically Meta would have had a 9% beat. So if Meta had just not had that charge off, which I think the street can ignore that. I mean, the algos are not going to ignore it, but maybe that shouldn't be something that has that much of an impact. Microsoft right here. I want to get it deeper into Microsoft's cloud revenues, and we'll pull that up in a second because that's the big story for Microsoft. Real quick before that, ServiceNow, they beat on the top and the bottom, 482 versus 427, beat by 12%. Revenue beat by 1.4%. ServiceNow, that stock is up about 2% after hours. And then you had Carvana. They missed on EPS. We're seeing a lot of different stuff happen in the car market with delinquencies. 137 versus 103 revenue. They beat 565 versus 501. So that stock is down, even though they beat on revenues. Google's going to be starting at 4:30, guys. So in 15 minutes, we'll open up Google. We'll get to Meta and Microsoft once Google is done, but all three of these calls will be happening at the same time. So we'll try to get updates.
So Transmedics reported too, apparently. TMDX down 10%.
Down. Okay, they beat by 83% on EPS, missed by 1% on revenue. That stock is indeed down 10%, but at least you're seeing that top line beat or the bottom line beat, which is important. Chipotle just reported. Let me pull that up real quick, and then we'll get into Microsoft.
Around a bit in the after hours here. Now it's higher by more than 3%. Its third quarter results essentially in line for Chipotle. The company lowering, though, its full year same store sales guidance now for the third quarter in a row. It now expects low single digit decline versus a prior forecast of flat. Now that's despite its EPS coming in right in line at 29 cents. Revenue is also in line at $3 billion for the quarter. Same store sales also up 0.3%. Its average check is up 1.1%, but traffic did fall by just under 1% in the quarter. Restaurant margin about 24.5%. That's 1% lower than analyst estimates. It says due to higher beef and chicken costs along with the impact of tariffs. Now, CEO Scott Boatwright telling me in a CNBC exclusive interview that younger consumers under 100K annual income are pulling back a bit in the quarter. Take a listen.
We've seen a pretty sizable step down in the consumer that's under $100,000 in annual income. Specific to that is a group that 25 to 34-year-old, which we over-index to, has pulled back measurably. And we believe that
that is the first time we're hearing from a restaurant that a consumer making less than 100K, they are seeing less foot traffic for. So that is definitely something all of us have to pay attention to. If that's happening at Chipotle, that's probably happening at other restaurants, and it's showing a bit of a bifurcation within the labor market and obviously people that are just starting out their careers. I mean, if they're not eating at Chipotle, then, either Chipotle is too pricey or there's some issues with their income that isn't allowing them to afford Chipotle. So that is a bit of news that's important for the consumer. Chipotle right there down 1%. Google still holding its move, 288.71. Chipotle is just mid. Okay. Maybe
it's crazy with Google, right? First $100 billion quarter. That's wild on the revenue.
Is it the first Google $100 billion revenue quarter?
Yeah, I think that's what they just meant. They mentioned on their press release here. We delivered our first ever $100 billion quarter.
Okay, so let me pull it up right here. Real quick, this is Microsoft. So we are looking at on cloud, 49.1 billion. Street had 48, so they beat. Intelligent Cloud 30.9, personal computing 13.8 versus 12.8. Adjusted EPS again 413. Net income, Microsoft did about $28 billion of profits. I guess the street wanted something a bit higher than Google right there at 290. Here is what Sundar said. Alphabet had a terrific quarter with double-digit growth across every part of our business. We delivered our first ever $100 billion quarter. Our full stack approach to AI is delivering strong momentum, and we're shipping at speed, including the global rollout of AI overviews and AI mode in search in record time. In addition to topping leaderboards, our first-party models like Gemini now process 7 billion tokens a minute via direct API use by our customers. The Gemini app now has over 650 million monthly active users. By the way, 3 months ago, that was 450 million. So that's up 200 million. We continue to drive strong growth in new businesses. Google Cloud accelerated, ending the quarter with 155 billion in backlog, and we have 300 million paid subscribers, led by Google One and YouTube Premium. Okay, not too bad. Sam, any thoughts on some of these Google numbers as we're seeing it come through?
I calculated that cloud growth. It was 28%, which is still pretty nice. I mean, they're getting bigger, so law of large numbers. But I mean, like, what can you say? They're definitely winning the LLM market. I think they're still number one, right? They're still the number one LLM in the world, or chatbot in the world. I think they're probably going to continue doing so. If you really think about a company that's very experienced at monetizing search, even when it comes to AI search, at some point they're going to start monetizing that. This is the company, right? So it's just seeing a quarter like that, you're seeing the money rotate pretty much out of Meta, out of Microsoft. This is just going by price action and going to Google. That's just what it looks like right now after hours. Because this is a lot of money, dude. This is a lot of money moving after hours, and it's going to go somewhere. So one of them had to be up.
And if we see, I mean, that cloud, the slide with cloud, a few things that really caught my attention is similar type of revenue growth. Even though Sam mentioned, right, the law of large numbers, they still, last year they grew 35%. Still, they're growing 34%. I'm going to guess due to this massive demand in AI solutions and AI cloud infrastructure. But more importantly, if you look at that operating margins,
Yep.
huge growth. I mean,
That is
huge
big.
growth. Yeah, now 23.7%, about 2 billion, now 3.6.
How do you think Google increased that by 6%? Just more efficiencies? Because that is impressive, dude.
So cloud is you reduce overhead as you scale out. So the larger you get, the more your operating margins go up. Like AWS is like around 31.5% or something last quarter. So it's no surprise. The bigger that they get, the more efficient they get, because it's just, you don't need to multiply how many engineers you have when you're just automating the whole thing. Wait, so they grew at 35% their cloud?
34.
Oh wow, 34%. That's actually pretty good. That's pretty good. That's pretty good.
Yeah, and also just with the overall kind of in AI infrastructure utilization, right? If you have one server, but that one server is being used 100% of the time, you're going to be able to increase on your margins dramatically faster than if you had that same server only running 80% of the time or 70% of the time. So pricing power there on the cloud aspect, but also the utilization rate are two things that I think can help accelerate that number pretty nicely.
I agree. Google right there at 290. I'm going to pull up Google Q2 2025 real quick and compare what Sundar said. So it looks like you're right, Jose. They did increase. Yeah, look at this. So they said 85 billion. This is Q2. This was 3 months ago. The most recent quarter is 91 to 93. That's an increase. So on the high end, that's an $8 billion increase on CapEx. If the other,
That is so bullish for data center stocks. That's what you want to see.
NVIDIA right there, 207. Some of the other data center names after hours, moving a little bit. Nebius and CoreWeave.
I'm curious to see how Broadcom, because obviously Broadcom is one of the ones that make with TPUs. Usually they kind of move with CapEx a little bit more than NVIDIA. Any movement? No, don't see much. Pretty much flat from close. But yeah,
it did hit an all-time high today, which is crazy, right? Jose, your reaction to Meta. Let me pull up Meta slides. But do you think it's justified because of this tax miss that they have?
I had to read through it, but a tax miss, I mean, I don't think would be something that would create for me to sell a Meta, right? So would love to read more on if there's any major changes. Are they slowing down was there any slowdown anywhere else? But just there, we see ad impressions were up 14%. We also saw kind of the pricing increase.
Yeah, you got average price per ad up 10 or up 10%, impressions up 14, and then DAP still up 8% in terms of daily active people. Here's what Meta said on this non-cash charge impact. We expect a significant reduction in our U.S. federal cash tax payments for the remainder of 2025 and our future years due to the implementation of the One Big Beautiful Bill Act. However, the implementation also led to the recognition of a valuation allowance against our U.S. federal deferred tax assets, reflected the impact of U.S. corporate alternative minimum tax. As a result, the third quarter 2025 provision for income taxes includes a one-time non-cash income tax charge of $15.93 billion. Excluding this one-time tax, our third quarter effective tax rate would have decreased to 14%. Net income would have increased to 18.64 billion, and then diluted EPS would have been 7.25. Yeah, this seems like a nothing burger.
Wait, so they reduced their tax payment? Is that what they're saying?
So
I didn't read.
I am not an accountant, but from what it seems like they're saying is that they were deferring certain payments based on the valuation against different assets they had. The Big Beautiful Bill had some change up in terms of how you're able to value those assets and then how long you're able to defer stuff. And that led to them recognizing $15.9 billion in taxes they had to pay.
Yeah, because I know with the big beautiful bill, one thing that you can kind of write off right away was your AI servers, right? Historically, you had your AI servers, you had to distribute it over, I think, 5-year time frame or whatever time frame, some longer time frame. But now with the big beautiful bill, you are able to defer everything at once. I don't know if that's what's happening here, but if there was any changes, I wonder if it comes with that aspect. Again, I would have to do a little bit more research, but that would be the first thing in my mind.
Yeah, you know, when Chad mentioned Scale AI, that's what it kind of sounds like. It almost sounds like exactly what they invested in Scale. I don't know if the investment would mature so quickly for them to defer the assets, but 15 billion is what they put into Scale. It almost seems like that's what they've had to pay. Maybe it's just a coincidence that it was 15 billion, but
Or I
outside of that,
wonder, because I know the big beautiful bill include just anything, pretty much research and development in the AI aspect here in the United States. So I wonder if that was, like you mentioned with the Scale AI, if they were
right.
able to just write it off. Again, that knowledge, I'm not a tax person, but with the big beautiful bill, you were able to expense everything a lot faster than normal.
Street really doesn't like it. I mean, outside of that, I don't see anything else that we should be upset about. Revenue's up 26%, guys. This is a $2 trillion company. That is not small growth. Income from operations up 18%. Operating margins decreased slightly, but at a far lower rate than the revenue growth. Net income, that is up again because of that 15 billion. That's what takes it down. But if it wasn't, it would be up almost 30% year over year. And you're seeing broader growth outside of the other parts of the business. Meta said we had a strong quarter for our business and community. Meta Superintelligence Labs is off to a great start, and we continue to lead the industry in AI glasses. If we deliver even a fraction of the opportunity ahead, then the next few years will be the most exciting period in history. Yeah, this doesn't feel that scary for Meta based on these numbers. Let's get some coverage right here on Microsoft and see what the street thinks about this one.
Yes, the street went a little bit higher on that growth that you just mentioned. And I think that's really largely it. All the other metrics look good. I think the street's not picking up on the booking and the actual RPO. And if you look at those numbers, you're talking about a commercial booking number at 112%, a 50+% growth in RPO. That's one of the best growth rates we've ever seen. And that does not include the new commitment from OpenAI of 250 billion incremental. So OpenAI helped them in the quarter, but all this 250 billion is not in that number as they indicated in the release. So I don't think the market's picking up on that. So that to me is the future indication of health of this company is just blew the doors off on RPO and bookings growth, which is again the most important thing that we look at as software analysts. What's the future indication of health? That's it. CapEx was a little bit higher, which everyone had expected, and you saw Google and Meta also raise their guidance. So everyone's asking what's happening to CapEx. We just got basically a raise from all three, from what we can see. And then when you think about margins, everyone's like, well, how can you make money in AI? She put up, Amy, the CFO of Microsoft, put up better margins than expected. So this is further indication that they're making money on AI, that they're not effectively, losing capital on this investment. They're actually driving really good margin improvement.
So the stock's down 3% in overtime right now, and I realize we still have to get through a conference call here too. Do you buy on this dip?
We do. If you look at the booking number, you can't find too many companies growing their backlog, commercial book backlog over 100, and their RPO, which is the remaining performance obligation, over 50. And that's an indication of what's to come for the next several quarters. So we're buyers on Microsoft.
How does this speak to what we saw?
Okay, so Google actually delayed their call, so we have some time.
Just kidding.
Usually Google does it at 4:30. They're doing it at 5:30. I think Meta we might actually get to start off with first, as Meta does it at 5. No, Meta's starting at 4:30. Is that? Yeah, Meta's start. Okay.
Oh, wow. Okay. Yeah.
I guess they did a switcheroo.
Yeah.
They also did a switcheroo on the stock price. Last time Meta went up, Google went down. This time Meta goes down, Google's. I guess they traded places. All right. So for those that care about Zucks, we're going to start off with Zucks in a couple minutes. I mean, overall, how is everyone feeling? It's, if you bet, I think the majority of the chat bet Google was going to be the winner. Obviously, that has played out. 290 on the Googs. Microsoft already recovering. I mean, it's still down 2%, but it's not as ugly. Meta, the tax thing is stupid, but nonetheless, maybe there's a different reason the street's upset, and that's why it's down. And that's what you got. eBay's down a bit. Looks like they didn't have the best earnings. Chipotle, again, a lot of you guys were asking, how does Chipotle know the amount of income of their users?
I was curious about that too.
I don't know either, bro. Like, that's a good question. Like, how does he
How
know?
are they collecting this info?
Do they read your credit card? But how do they know? I guess the people in their app, maybe, but still.
Yeah, I don't remember putting that in the app. I don't remember it asking me. Maybe it's by the demographics of where the store's located. So, you know, I mean, if you ask me, like, where Chipotle is usually located. Usually located in kind of middle class areas.
Everywhere.
I mean, they're everywhere, but the ones in like the middle class areas are, from what I've seen, is where the Kavas are, where all those nice restaurants are. And it's like, dude, Chipotle's like $12 for a bowl when it used to be like $7.
That's
I
true.
might as well just eat at a restaurant, right? So,
and I thought they give you free guac with the chips. Apparently, the guac is extra. I thought years ago it used to be.
oh my goodness, that would be insane giving guac for free.
Real quick before Meta, this is Starbucks.
Earnings to bring you. Starbucks results are out. Kate Rogers has those numbers. Hi, Kate.
Hey, Morgan. So the stock a little bit higher here, as you can see, by more than 1.5%. A mixed fourth quarter for Starbucks. EPS a miss here, 52 cents adjusted versus estimates of 56 cents. Revenues, though, a beat, $9.6 billion for the quarter versus the $9.35 billion estimated. And that's even with the labor investments that the company is making right now. Comps turning positive globally. Q4 comp sales up 1%, better than the 0.3% decline estimated. Q4 North American comp sales flat versus 0.9% estimates. Transactions declined in North America, but noteworthy update here. U.S. comps did turn positive in September as the company's Back to Starbucks plan takes shape. Q4 international comp sales also better than expected, up 3%. It's China same-store sales, second home market there, also up 2%. We're going to be looking out for any guidance and any updates on China and that market on the earnings call, guys. We'll bring you updates as we get them. Back over to you.
Kate, thank you. I do want to mention.
So Starbucks not going as bad as Chipotle. That stock basically flat. But Chipotle is the one that's taking a bigger of a hit. Okay, so that's what we got with earnings. 3 most important companies outside of Amazon and Apple reported. Google, this story is remarkable. Google stock year to date, 44%, bottomed in April around 143, came back to 150 by June. Just a massive, massive move. And then Microsoft, looks like cloud revenue was just a little bit flat, as Jeffries was saying, and that's why it's taken a bit of a hit, but still up 30%, even with this 2% decline that we're seeing after hours. All right, here we go. Zucks is starting. Let me pull this up, and then we will switch over.
Joining me today are Mark Zuckerberg, CEO, and Susan Li, CFO. Our remarks today will include forward-looking statements which are based on assumptions as of today. Actual results may differ materially as a result of various factors, including those set forth in today's
Meta also
earnings
increased their
press release
capex on the
and
lower
in our
end.
quarterly report on Form 10-Q filed with the SEC. We undertake no obligation to update any forward-looking statement. During this call, we will present both GAAP and certain non-GAAP financial measures. A reconciliation of GAAP to non-GAAP measures is included in today's earnings press release. The earnings press release and an accompanying investor presentation are available on our website at investor.appmeta.com. And now I'd like to turn the call over to Mark.
All right, thanks, Ken. Thanks, everyone, for joining today. We had another strong quarter with 3.5 billion people using at least one of our apps every day. Instagram hit a major milestone with 3 billion monthly actives, and we're seeing good momentum across our other apps as well, including Threads, which recently passed 150 million daily actives and remains on track to become the leader in its category. I am very focused on establishing Meta as the leading frontier AI lab, building personal superintelligence for everyone, and delivering the app experiences and computing devices that will improve the lives of billions of people around the world. Our approach of advancing open source AI means that when Meta innovates, everyone benefits. Meta Superintelligence Labs is off to a strong start. I think that we've already built the lab with the highest talent density in the industry. We're heads down developing our next generation of models and products, and I'm looking forward to sharing more on that front over the coming months. We're also building what we expect to be an industry-leading amount of compute. Now, there's a range of timelines for when people think that we're going to get superintelligence. Some people think that we'll get there in a few years. Others think it will be 5, 7 years or longer. I think that it's the right strategy to aggressively front-load building capacity so that way we're prepared for the most optimistic cases. That way, if superintelligence arrives sooner, we will be ideally positioned for a generational paradigm shift and many large opportunities. If it takes longer, then we'll use the extra compute to accelerate our core business, which continues to be able to profitably use much more compute than we've been able to throw at it. And we're seeing very high demand for additional compute, both internally and externally. And in the worst case, we would just slow building new infrastructure for some period while we grow into what we build. The upside is extremely high for both our existing apps and new products and businesses that are becoming possible to build. Across Facebook, Instagram, and Threads, our AI recommendation systems are delivering higher quality and more relevant content, which led to 5% more time spent on Facebook in Q3 and 10% on Threads. Video is a particular bright spot, with video time spent on Instagram up more than 30% since last year. And as video continues to grow across our apps, Reels now has an annual run rate of over $50 billion. Improvements in our recommendation systems will also become even more leveraged as the volume of AI-created content grows. Social media has gone through 2 eras so far. First was when all content was from friends, family, and accounts that you followed directly. The second was when we added all of the creator content. Now, as AI makes it easier to create and remix content, we're going to add yet another huge corpus of content on top of those. Recommendation systems that understand all this content more deeply and can show you the right content to help you achieve your goals are going to be increasingly valuable. Our ads business continues to perform very well, largely due to improvements in our AI ranking systems as well. This quarter, we saw meaningful advances from unifying different models into simpler, more general models, which drive both better performance and efficiency. And now, the annual run rate going through our completely end-to-end AI-powered ad tools has passed $60 billion. Now, one way that I think about our company overall is that there are 3 giant transformers that run Facebook, Instagram, and ads recommendations. We have a very strong pipeline of lots of ways to improve these models by incorporating new AI advances and capabilities. And at the same time, we are also working on combining these 3 major AI systems into a single unified AI system that will effectively run our family of apps and business, using increasing intelligence to improve the trillions of recommendations that we'll make for people every day. I'm also very excited about the new products that we're going to be able to build. More than 1 billion monthly actives already use Meta AI, and we see usage increase as we improve our underlying models. I'm very excited to get a frontier model into Meta AI, and I think that the opportunity there is very large. The same goes for our business AI. Every day, people have more than 1 billion active threads with business accounts across our messaging platforms, ranging from product questions to customer support. Our business AIs will enable tens of millions of businesses to scale these conversations and improve their sales at low cost. And the better our models get, the better this is going to work for all businesses. This quarter, we also launched Vibes, which is the next generation of our AI creation tools and content experiences. Retention is looking good so far, and its usage keeps growing quickly week over week. I'm looking forward to ramping up the growth of Vibes over the coming months. More broadly, I think that Vibes is an example of a new content type enabled by AI, and I think that there are more opportunities to build many more novel types of content ahead as well. As our new models become ready, I'm looking forward to starting to show everyone some of the new kinds of products that we're working on. At Connect, we announced our 2025 line of AI glasses, and the response so far has been great. The new Ray-Ban Meta glasses and Oakley Meta Vanguards are both selling well as people love the improved battery life, camera resolution, new AI capabilities, and the great design. And there's our new Meta Ray-Ban display glasses, our first glasses with a high-resolution display and the Meta neural band to interact with them. They sold out in almost every store within 48 hours, with demo slots fully booked through the end of next month. So we're going to have to invest in increasing manufacturing and selling more of those. This is an area where we are clearly leading and have a huge opportunity ahead. Taking a step back, if we deliver even a fraction of the opportunity ahead for our existing apps and the new experiences that are possible, then I think that the next few years will be the most exciting period in our history. We've got a lot to do, but we're making real progress, delivering strong business results, building the talent density and infrastructure needed for the next era, and leading the way on AI devices that will define the next computing platform. I'm proud of how our teams are rising to the challenge, and I'm grateful for their dedication, hard work, and creativity. As always, thank you all for being a part of this journey with us. And now, here's Susan.
Thanks, Mark, and good afternoon, everyone. Let's begin with our segment results. All comparisons are on a year-over-year basis unless otherwise noted. Our community across the family of apps continues to grow, and we estimate more than 3.5 billion people used at least one of our family of apps on a daily basis in September. Q3 total family of apps revenue was $50.8 billion, up 26% year over year. Q3 family of apps ad revenue was $50.1 billion, up 26%, or 25% on a constant currency basis. In Q3, the total number of ad impressions served across our services increased 14%. Impression growth was healthy across all regions, driven by engagement and user growth, particularly on video surfaces. The average price per ad increased 10% year over year, benefiting from increased advertiser demand, largely driven by improved ad performance. This was partially offset by impression growth, particularly from lower monetizing regions and surfaces. Family of apps other revenue was $690 million, up 59%, driven by WhatsApp paid messaging revenue growth, as well as Meta verified subscriptions. Within our Reality Labs segment, Q3 revenue was $470 million, up 74% year over year. The significant year-over-year growth in Q3 was partly due to retail partners stocking up on Quest headsets ahead of the holiday season. We did not have a similar benefit in the third quarter of last year, since our Quest 3S headset launched in the fourth quarter of 2024. Aside from this, strong AI glasses revenue also contributed to revenue growth in Q3. Moving now to our consolidated results. Q3 total revenue was $51.2 billion, up 26% or 25% on a constant currency basis. Q3 total expenses were $30.7 billion, up 32% compared to last year. Year-over-year expense growth accelerated 20 percentage points from Q2, due primarily to three factors. First, legal-related expense growth was higher than in Q2, due to charges we recorded in the third quarter, as well as us lapping a period of accrual reversals in the third quarter a year ago. Second, employee compensation growth accelerated, driven by technical hires, particularly AI talent. Finally, growth in infrastructure costs accelerated due to increased infrastructure operating costs associated with our expanded data center fleet, depreciation on our incremental CapEx spend, and third-party cloud spend. We ended Q3 with over 78,400 employees, up 8% year over year, driven by hiring in priority areas of monetization, infrastructure, Reality Labs, Meta Superintelligence Labs, as well as regulation and compliance. Third quarter operating income was $20.5 billion, representing a 40% operating margin. Q3 interest and other income was $1.1 billion, driven primarily by unrealized gains on our marketable equity securities. Our tax rate for the quarter was 87%, which was unfavorably impacted by a one-time non-cash reduction in deferred tax assets that we no longer anticipate using under new U.S. tax law. Our tax rate would have been 14%, excluding this charge. Although the transition to the new U.S. tax law resulted in an accounting charge in the third quarter, we continue to expect we will recognize significant cash tax savings for the remainder of the current year and future years under the new law, and this quarter's charge reflects the total expected impact from the transition to the new U.S. tax law. Net income was $2.7 billion, or $1.05 per share. Excluding the one-time tax charge, our net income and EPS would have been $18.6 billion and $7.25 per share, respectively. Capital expenditures, including principal payments on finance leases, were $19.4 billion, driven by investments in servers, data centers, and network infrastructure. Free cash flow was $10.6 billion. We repurchased $3.2 billion of our Class A common stock and paid $1.3 billion in dividends to shareholders. We ended the quarter with $44.4 billion in cash and marketable securities and $28.8 billion in debt. Turning now to the business outlook, there are two primary factors that drive our revenue performance: our ability to deliver engaging experiences for our community and our effectiveness at monetizing that engagement over time. On the first, daily actives continue to grow year over year across Facebook, Instagram, and WhatsApp. We're continuing to see improvements to our products and recommendations drive incremental engagement, with year-over-year growth in global time spent accelerating on both Facebook and Instagram in Q3. In the US, overall time spent on Facebook and Instagram grew double digits year over year, driven by continued video strength as well as healthy growth in non-video time on Facebook. The engagement gains continue to be driven by product work and ongoing improvements to our recommendation systems as we optimize our model architectures, implement advanced modeling techniques, and integrate more signals about people's interests. We also continue to focus on increasing the freshness of recommended content. On Facebook, our systems are now surfacing twice as many reels published that day than at the start of the year. Looking to 2026, we expect to advance our recommendation systems across several dimensions. On Instagram, one focus is evolving our systems to surface content across a broader set of topics that cater to the diverse interests of each person. This follows a similar approach we've implemented on Facebook that has driven good results. We also expect to make significant progress on our longer-term ranking innovations in 2026. We're seeing promising new results from our research efforts to create foundational ranking models and expect the new model innovations we're developing as part of this will enable us to significantly scale up the amount of data and compute we use to train our recommendation models in 2026, yielding more relevant recommendations. Another large focus next year is leveraging LLMs to improve content understanding. We expect this is going to enable our systems to more precisely label the keywords and topics within videos and posts, which will allow our systems to both develop deeper intuition about a person's interests and retrieve the content that matches them. Finally, we're making good progress with Meta AI and Threads. The number of people using Meta AI across our family of apps continues to grow, and we're increasingly leveraging first-party content into Meta AI results, with the majority of Meta AI's responses to Facebook deep dive queries in the US now showing related reels. We're also seeing a lot of traction with media generation. People have created over 20 billion images using our products, and since launching Vibes within Meta AI in September, we've seen media generation in the app increase more than tenfold. On Threads, we see strong growth in both daily actives and the depth of engagement as we continue to improve recommendations. The ranking optimizations we made in Q3 alone drove a 10% increase in time spent on Threads. We also continue to ship new features, including launching direct messaging in Q3, so anyone on Threads can now message one another within the app. Now to the second driver of our revenue performance: increasing monetization efficiency. The first part of this work is optimizing the level of ads within organic engagement. We continue to refine ad supply across each of our major surfaces within Facebook and Instagram to better deliver ads at the time and place they are most relevant to people. Longer term, we have exciting ad supply opportunities on both Threads and WhatsApp Status. Ads are now running globally in feed on Threads, and we're following our typical monetization playbook of optimizing the ads formats and performance before we ramp supply. Within WhatsApp Status, we're continuing to gradually introduce ads and expect to complete the rollout next year. The second part of increasing monetization efficiency is improving marketing performance. Advancing our ad systems remains a critical aspect of this work, and we are driving performance gains through ongoing improvements in our larger scale ads ranking models. For example, we continue to broaden the adoption of Lattice, our unified model architecture. In Q3, we rolled out Lattice to app ads, which drove a nearly 3% gain in conversions for that objective. Since introducing Lattice back in 2023, along with other backend improvements, we have now cut the number of ads ranking and recommendation models by approximately 100, as we consolidated smaller and more specialized models into larger ones that use the Lattice architecture to generalize learnings across surfaces and objectives. We continue to observe performance improvements as we combine models and expect to drive additional gains as we consolidate another 200 models over the coming years into a smaller number of highly capable models. In addition to advancing our foundational ads models, we're innovating on our runtime models we use downstream of them for ads inference. For example, we began piloting a new runtime ads ranking model in Q3 that leverages more compute and data than our prior models to select more relevant ads. In testing, we've seen this new model drive a more than 2% lift in conversions on Instagram. We also significantly improved performance of Andromeda in Q3 by combining models across retrieval and early stage ranking into a single model, driving a 14% increase in ads quality on Facebook surfaces. Within our ads products, we're seeing continued momentum with Advantage Plus. In Q3, we completed the rollout of our streamlined campaign creation flow for Advantage Plus lead campaigns. So now advertisers running sales, app, or lead campaigns have end-to-end automation turned on from the beginning, allowing our systems to look across our platform to optimize performance by automatically choosing criteria like who to show the ads to and where to show them. The annual run rate of revenue running through our end-to-end automated solutions has now reached $60 billion following the implementation of the new streamlined creation flow, as we continue to see more advertisers leverage the performance benefits of our solutions. Within our Advantage Plus Creative Suite, the number of advertisers using at least one of our video generation features was up 20% versus the prior quarter, as adoption of image animation and video expansion continues to scale. We've also added more generative AI features to make it easier for advertisers to optimize their ad creatives and drive increased performance. In Q3, we introduced AI-generated music, so advertisers can have music generated for their ad that aligns with the tone and message of the creative. Finally, business messaging remains a significant opportunity for us. We're seeing strong growth across our portfolio of solutions, including with click-to-WhatsApp ads, which grew revenue 60% year over year in Q3. We're also making good progress on our business AI efforts, where we've been focused on building a turnkey AI that helps businesses generate leads and drive sales. We've been opening access in recent months to more businesses within our initial test markets, the Philippines and Mexico, and have seen strong usage with millions of conversations between people and business AIs taking place since July. This month, we expanded availability within WhatsApp and Messenger to all eligible businesses in Mexico and the Philippines, respectively. In the US, we're also starting to roll out the ability for merchants to add their business AIs to their website so we can support the full sale funnel from ad to purchase. Next, I would like to discuss our approach to capital allocation. Our primary focus is deploying capital to support the company's highest order priorities, including developing leading AI products, models, and business solutions. As we make significant investments in infrastructure to support this work, we are focused on preserving maximum long-term flexibility to ensure we can meet our future capacity needs while also being able to respond to how the market develops in the years ahead. We're doing so in several ways, including staging data center sites so we can spring up capacity quickly in future years as we need it, as well as establishing strategic partnerships that give us option value for future compute needs. The strong financial position and cash generation of our business enable us to make these investments while also accessing additional pools of cost-efficient capital. Moving to our financial outlook, we expect fourth quarter 2025 total revenue to be in the range of $56 to $59 billion. Our guidance assumes foreign currency is an approximately 1% tailwind to year-over-year total revenue growth based on current exchange rates. Our outlook reflects an expectation for continued strong ad revenue growth, partially offset by lower year-over-year Reality Labs revenue in Q4. The anticipated reduction in Reality Labs revenue is due to us lapping the introduction of Quest 3S in Q4 of last year, as well as retail partners procuring Quest headsets during Q3 of this year to prepare for the holiday season, which were recorded as revenue in the third quarter. Turning to the expense and CapEx outlooks, I'll first start with 2025 before providing some commentary on our planning for 2026. We expect full year 2025 total expenses to be in the range of $116 to $118 billion, updated from our prior outlook of $114 to $118 billion, and reflecting a growth rate of 22 to 24% year over year. We currently expect 2025 capital expenditures, including principal payments on finance leases, to be in the range of $70 to $72 billion, increased from our prior outlook of $66 to $72 billion. On to tax. Absent any changes to our tax landscape, we expect our fourth quarter 2025 tax rate to be 12 to 15%. Turning now to 2026. We are at an exciting point for our company, where we have continued runway to improve our core services today, as well as the opportunity to build new AI-powered experiences and services that will transform how people engage with our products in the future. We expect the set of investments we're making within our ads and organic engagement initiatives next year will enable us to continue to deliver strong revenue growth in 2026, while our progress on AI models and products will position us to capitalize on new revenue opportunities in the years to come. A central requirement to realizing these opportunities is infrastructure capacity. As we have begun to plan for next year, it's become clear that our compute needs have continued to expand meaningfully, including versus our own expectations last quarter. We are still working through our capacity plans for next year, but we expect to invest aggressively to meet these needs, both by building our own infrastructure and contracting with third-party cloud providers. We anticipate this will provide further upward pressure on our CapEx and expense plans next year. As a result, our current expectation is that CapEx dollar growth will be notably larger in 2026 than 2025. We also anticipate total expenses will grow at a significantly faster percentage rate in 2026 than 2025, with growth primarily driven by infrastructure costs, including incremental cloud expenses and depreciation. Employee compensation costs will be the second largest contributor to growth, as we recognize a full year of compensation for employees hired throughout 2025, particularly AI talent and ad technical talent in priority areas. Finally, we continue to monitor active legal and regulatory matters, including the increasing headwinds in the EU and the US that could significantly impact our business and financial results. For example, in the EU, we continue to engage constructively with the European Commission on our less personalized ads offering. However, we cannot rule out the Commission imposing further changes to that offering that could have a significant negative impact on our European revenue as early as this quarter. In the US, a number of youth-related trials are scheduled for 2026 and may ultimately result in a material loss. In closing, this was another good quarter for our business. We have an exciting set of opportunities to continue improving our core business while delivering innovative new experiences and services for the people and businesses using our products in the years to come. With that, Krista, let's open up the call for questions.
All right, Zucks.
Thank you. We will now open
Get us
the line
back to
for
720.
question and answer session. To ask a question, please press star 1 on your touchtone phone. To withdraw your question, again, press star 1. Please limit yourself to one question. Please pick up your handset before asking your question to ensure clarity. If you are streaming today's call, please mute your computer speakers. And your first question comes from the line of Brian Nowak with Morgan Stanley. Please go ahead.
Thanks for taking my questions. I have two for Susan. The first one, Susan, so the pipeline for core improvements to come in 26 with models and ad ranking models and more types of compute seems very exciting, and the infrastructure build seems sizable behind that. So can you help us a little understand some of the early quantifiable signals you're seeing on A/B tests from some of these improvements to come that sort of make you most excited and give you confidence you're going to get ROIC from all this CapEx? That's the first one. Second one's a little faster. How large is the Reality Labs revenue headwind in the 4Q guidance? Thanks.
Thanks, Brian, for the question. I think your first question had a couple parts to it, so I'm going to try to disaggregate those parts and let me know if this addresses what you're getting to. I will say that the growth in 2026 CapEx relative to 2025 comes from growth in each of the core areas, MSL, core AI, as well as non-AI spend. So all of those areas are growing, but the MSL AI needs are growing the most. In terms of the core AI pipeline, I think we talked about last year when we were going into the 2025 budget process, we had a roadmap of resource investments across both headcount and compute that we thought would pay off, in 2026. And it's really a very broad range of sort of different ads ranking and performance efforts. And we're continuing to see that, those have paid off through the course of the year. There is a long list of specific efforts, but one of the measures that we look at to monitor this is how are we driving ad performance? How are conversions growing? Conversions is a complex metric for us because advertisers optimize for so many different conversions with different values. But when we control for that and look at value-weighted conversion rates, we're seeing very strong year-over-year growth, and weighted conversions continue to grow faster than impressions. We also talked about some of the new model architecture over the course of the year and the degree to which the new model architecture is enabling us also to take advantage of having more data and more compute to drive ads performance. So we expect that that's going to be a continued story in 2026. We are, in fact, at the beginning of our 2026 budgeting process now, and we, see a similar list of revenue investments that we're excited to be able to invest in. And so we think that that's going to be a big part of our ability to continue to drive strong revenue performance throughout the year. On your second question, which is the Reality Labs revenue headwind, I don't think we have quantified the exact size of that. We expect that Q4 Reality Labs revenue will be lower than last year for a couple reasons that I alluded to. The biggest factor is we're lapping the introduction of Quest 3S in Q4 of last year, and we don't have a new headset in the market this year. We also recorded all of our holiday-related Quest 3S sales in Q4 24 since the headset was launched in October 24. This year, we're recognizing some of those Quest 3S sales in Q3 as retail partners have procured Quest headsets in advance of the holiday season. We're still expecting significant year-over-year growth in AI glasses revenue in Q4 as we benefit from strong demand for the recent products that we've introduced, but that is more than offset by the headwinds to the Quest headsets.
Your next question comes from the line of Doug Anmuth with JP Morgan. Please go ahead.
Great. Thanks for taking the question. I appreciate the strategy to front load capacity for superintelligence. Can you just talk about your thought process in kind of triangulating the CapEx dollar growth and the significantly faster expense growth next year with core growth in the business, and then the impact on earnings and free cash flow? And do you have targets that we should be thinking about for cash on hand or net cash overall? Thanks.
Thanks, Doug. We're right now, I would say, in the process of we're relatively early, actually, still in the process of putting together our budget for 2026. And it is on the capacity side a particularly dynamic process. We're certainly seeing that we wish we had more capacity today than we do. We would be able to put it towards good use. Certain not only with the MSL team appreciate having more capacity, but we'd be able to put it towards good and ROI positive use in the core business as well. So we're really trying to plan ahead, not only to ensure that we have the capacity we need in 2026, but also to give ourselves these sort of flexibility and option value to have the capacity that we think we could need in 27 and 28. So that said, there are lots of moving pieces in the budget. It's not baked yet. It's still sort of in the process of coming together. We don't have, specific targets to share, but we do feel like, our strategic priority is really making sure that we have the compute that we need to be well positioned to succeed at AI. And, that's sort of the foremost priority as we're putting together the budget.
Yeah, I mean, I'll add a few thoughts on this too, although, I mean, as Susan said, we're still working through the actual budget, and I think we'll typically have more to share on that early next year. But to date, we keep on seeing this pattern where we build some amount of infrastructure to what we think is an aggressive assumption, and then we keep on having more demand to be able to use more compute, especially in the core business, in ways that we think would be quite profitable, than we end up having compute for. So I think that suggests that being able to make a significantly larger investment here is very likely to be a profitable thing over some period, because if the primary use of it is going to be to accelerate the AI research and the new AI work that we're doing and how that relates to both the core business and new products. But any compute that we don't need for that, we feel pretty good that we're going to be able to absorb a very large amount of that to just convert into more intelligence and better recommendations in our family of apps and ads in a profitable way. Now, I mean, it's of course possible to overshoot that, right? And if we do, I mean, this is what I mentioned in my comments, then, we see that there's just a lot of demand for other new things that we would build internally, externally. Like almost every week, people come to us from outside the company asking us to stand up an API service, or asking if we have different compute that they could get from us. And we haven't done that yet, but obviously if you got to a point where you overbuilt, you could have that as an option. And then the kind of the very worst case would be that we effectively have just pre-built for a couple of years, in which case, of course, there would be some loss and depreciation, but we'd grow into that and use it over time. So my view on this is that rather than continuing to be constrained on CapEx and feeling in the core business like we have significant investments that we could make that we're not able to make that would be profitable, that the right thing to do is to try to accelerate this to make sure that we have the compute that we need, both for the AI research and new things that we're doing, and to try to get to a different state on our compute stance on the core business. So that's kind of how I'm thinking about that overall. Of course, there's a lot of operational constraints too on what one can build, right? So we're basically trying to work through this all, and I think we'll have more to share in the coming months and over the course of next year. But I think that there's just a huge amount of opportunities ahead here.
Your next question comes from the line of Eric Sheridan with Goldman Sachs. Please go ahead.
Thanks so much for taking the question. Mark, wanted to reflect on some of your comments with respect to scaling towards superintelligence and bringing it back to consumer AI. Maybe reflect a little bit on the signals you've gotten on the way consumers across family of apps interact with Meta AI today, and how you think about scaling and exiting models from the superintelligence effort might change the utility and behavior around Meta AI in the years ahead. Thanks.
Yeah, I mean, a lot of people use Meta AI today. I mean, as I said in my comments up front, there's more than 1 billion people who use it on a monthly basis. And what we see is that as we improve the quality of the model, primarily for post-training Llama 4 at this point, we continue to see improvements in usage. So our view is that when we get the new models that we're building in MSL in there and get like truly frontier models with novel capabilities that you don't have in other places, then I think that this is just a massive latent opportunity, right? We know, I mean, I would guess that, Meta, I think, has the best track record of any company out there of taking a new product that people love and getting it to billions of people in terms of usage. So I think that the ability to plug in leading models is going to, I would predict, lead to a very large amount of use of these things over the coming years. So I'm very excited about that in terms of new products. It's not just Meta AI as an assistant. I think that there are going to be all kinds of new products around different content formats, and we're starting to see that with video and content creation. But I think that there's going to be a lot more like that I'm quite excited about. And then there are the business versions of all of these too, like business AI, and then. That's of course one part of the story is the new things that will be possible to build, and then the other part is how more intelligent models are just going to improve the core business and improve the recommendations that we make across the family of apps and improve the recommendations in advertising. And I think there's just as we've shown, there's sort of this very large amount of headroom, and the opportunity there keeps growing as we are improving and optimizing the AI there. And I think that really shows no sign of being near the end. I think that there's quite a bit more to do there. And, like I said in response to the last question, we are sort of perennially operating the family of apps and ads business in a compute-starved state at this point, which is, on the one hand, sort of an odd thing to say, given the compute that we've built up. But we really are, taking a lot of the resources and using them to advance future things that we're doing, and we think that there's a lot more compute that we could put towards these that would just unlock a huge amount of opportunity in the core business as well.
Your next question comes from the line of Mark Shmulik with Bernstein. Please go ahead.
Yes, thanks for taking the questions. Susan, as you think about the visibility into kind of the runway next year of continued ad performance and engagement improvements, how do you think about kind of the scale of those improvements versus kind of the progress we've seen over the last 2 years? And then Mark, as you think about kind of the timing of some of these newer efforts coming out of Superintelligence Labs, is us anchoring to kind of an updated frontier model launch sometime next year, like the right way for us to think about it? Or should we be looking at kind of progress from new products you're excited to see ship like Vibes? Thank you.
Thanks, Mark. So on the sort of ads improvement side, some of the innovations that we have been launching actually, involve sort of improving our larger scale models. So we, don't use our larger model architectures like GEM for inference because their size and complexity would make it too cost prohibitive. The way that we drive performance from those models is by using them to transfer knowledge to smaller, lightweight models that are used at runtime. And then in addition to the foundation model work, we are working on advancing our inference models by developing new techniques and architectures that then allow us to scale up compute and complexity in an ROI positive way. So in general, we obviously have a very large base of, advertisers. There's a lot of demand liquidity in the system. And even, small scale improvements that we are able to make in terms of driving, basis point improvements in the performance of ads or single digit, increases in conversions relative to impressions in a given quarter, off of a large base mean that we're really able to continue to grow the absolute dollars of revenue growth in a pretty meaningful way.
Your next question comes from the line of Justin Post with Bank of America. Please go ahead.
Actually,
thank you.
Hey, Justin, just give us 1 second. I think there was a second
Sure.
Mark's question that we just want to get to on MSL.
Yeah, I mean, I'll keep it quick. I mean, I don't think we have any specific timing to announce certainly on the models or products, but I expect that you will see both. We expect to build novel models and novel products, and I'm excited to share more when we have it.
Krista,
Justin, please go ahead.
Great, thanks. Mark, you mentioned the prior 2 content cycles, and obviously you've been able to generate very attractive margins on them. As we get into the AI cycle, obviously some concerns on the investment, but can you talk a little bit about how you're thinking about, tools that could be coming out for users? I know there's some new competition. And then secondly, how you think about margins in this content cycle? Any reason to think they would be different versus prior cycles? Thank you.
I think it's too early to really understand what the margins are going to be for the new products that we build. I mean, I think certainly each product has somewhat different characteristics, and I think we'll kind of understand how that goes over time. I mean, my general goal is to build a business that maximizes value for the people who use our products and maximizes profitability, not margin. So I think we'll kind of just try to build the best things that we can and try to deliver the most value that we can for most people.
Your next question comes from the line of Ross Sandler with Barclays. Please go ahead.
Great. Hey, Mark, some of the goals for competing AI labs are around achieving AGI or these other milestones that are kind of like out there and a little esoteric. How are you setting up your new team in terms of achieving those types of goals versus products that can generate revenue from Meta kind of right out of the gate? And is the goal that you had articulated to us previously around giving, billions of people kind of a personal AI to use, still the direction of travel that you see, or is there, other things like kind of this Vibes or Sora angle that you think are potentially important? How should we think about like the overall direction? Thank you.
Sure. So the way that I think about this is that the research is going to enable new technological capabilities to exist. And then those capabilities can get built into all kinds of different products. So the ability to reason more intelligently is, for example, very important across a large number of things. It would be useful for an assistant. It will also be useful in business AI. It will also be useful in the AI agent that we're building to help advertisers figure out what their campaigns are going to be. It will also have implications for eventually how we do ranking and recommendations of people's feeds and make different decisions there. That's just one example. I mean, certainly the capability to be able to produce very high quality, good video is going to be useful for giving people new creative tools. It will help increase the amount of content inventory that can be shown in Instagram and Facebook, and therefore should enable an increase in engagement there. It should help advertisers be able to create creative that will help us monetize better. So you can just go kind of down the list of capabilities that you'd expect. And I think each one will enable a bunch of different things. And I think the art of product development here is looking at the list of technology capabilities and figuring out what new products are going to be useful and prioritizing those. But fundamentally, I would sort of expect this exponential curve in new technology capabilities that are going to become available. And the other thing that I expect is that I think being the best in a given area will drive great returns rather than, this is not like a check the box exercise of like, okay, we can generate some kind of content and someone else can. I think that like the company that is the best at each of these capabilities, I think will get a large amount of the potential value for doing that. So there are lots of different capabilities to build. I'm not sure that any one company is going to be the best at all of them. I doubt that's going to be the case. But a lot of what we're trying to do is not kind of do some things that others have done. We're really trying to build novel capabilities. And I'm keeping this high level because I don't want to necessarily from a competitive or strategic perspective get into what we're prioritizing. But that hopefully gives you a sense of how we're thinking about what we're doing. We want to be able to kind of build novel things, build them into a lot of our products, and then have the compute to scale them to billions of people. And we think that that's going to both show up in terms of new products being possible and new businesses, and very significant improvements to the current business too.
Your next question comes from the line of Mark Mahaney with Evercore ISI. Please go ahead.
Thanks. Can I just ask just a question on Meta AI and both the product and a monetization path? So when you look at it, what you've seen that's most encouraging to you in terms of the adoption and the use of Meta AI, and then when you think about, I know you generally like to roll out and then deepen engagement, and then later think about monetization. Like, where do you think you are on that path now? Is it clear to you what the monetization options are for Meta AI? Thank you very much.
I mean, I think the most promising thing that we're seeing is one, that we were able to build something that a large number of people use, and I think that that's valuable. And then secondly, that there is a clear correlation as we improve the models in ways that we think make them better, that people use them more. So that shows that we have a runway to basically be able to improve engagement and turn this into a product that's leading over time. In terms of where we are on this, and we basically just did this huge effort to boot up Meta Superintelligence Labs and build what I am very proud of is, I think, the highest talent density lab in the industry at this point. There are a lot of really great researchers and infrastructure folks and data folks who are now a part of this effort, who are focused on training the next generation of work and doing some really novel work. And when that is ready, I think that we will be able to plug that into a number of the products that we're building, and I think that will be very exciting. But I think that that's really the next thing that we're looking at. And then from there, I think that these models will also improve monetization in all of the different ways that we've talked about so far, in terms of improving engagement, improving advertising, helping advertisers engage. I mean, there's the one opportunity that we usually talk about on these calls, but hasn't come up as much here, is just the ability to make it so that advertisers are increasingly just going to be able to give us a business objective and give us a credit card or bank account, and like have the AI system basically figure out everything else that's necessary, including generating video or different types of creative that might resonate with different people, that are personalized in different ways, finding who the right customers are. All of the capabilities that we're building, I think, go towards improving all of these different things. So I'm quite optimistic about that.
Your next question comes from the line of Ronald Josey with Citi. Please go ahead.
Great. Thanks for taking the question. And this maybe dovetails perfectly off of, Mark, what you just talked about. And, we heard a lot about end-to-end automation here, I think reaching a $60 billion ARR. Wanted to hear about, if you can talk to us more just about adoption rates amongst the advertisers, and then maybe bigger picture, as you incorporate ranking recommendation changes like Andromeda or GEMS or Lattice, just talk to us how this automation is driving, call it, a higher ROI for advertisers overall as we bring it all together. Thank you.
Yeah, so we've been sort of laying the continued brick by brick build of Advantage Plus and extending the set of objectives that it applies to over time. And so in Q3, we completed the global rollout of the streamlined campaign creation flow for Advantage Plus lead campaigns. So now advertisers who are running sales app or lead campaigns have end-to-end automation turned on from the beginning. And like, the kind of application of the streamlined campaign creation flow for other objectives, this generally allows advertisers to optimize and automate several aspects of the campaign setup process at once. That includes things like audience selection, where to show the ad, how the budget gets paced and distributed across ad sets to drive the most efficient outcomes. And, we see that Advantage Plus continues to drive performance gains. Advertisers who run lead campaigns using Advantage Plus are seeing a 14% lower cost per lead on average than those who are not. And I would say that we think that there is still a lot of opportunity generally to grow adoption of Advantage Plus. A lot of advertisers only use our end-to-end automated solutions for a portion of their campaigns, so we can grow share there. And to capture that opportunity, we're focused on driving continued performance improvements and addressing some of the key use cases that we still need in order to grow adoption. We're also working to broaden adoption among advertisers who use one of our single-step automated solutions. For example, advertisers who might only use a piece of it, like Advantage Plus Audiences, by helping them understand the benefits of using more than one automated solution at the same time. So I would say Advantage Plus is sort of an ongoing platform by which we both continue to expand the feature set that is available in Advantage Plus, and then expand the extensibility or the coverage of that feature set to sort of the broader set of advertisers. I think Mark mentioned that the annual revenue run rate now for advertisers who are using these automated options is, $60 billion. And again, we see that there's room to continue growing that.
Your next question comes from the line of Youssef Squali with Truist Securities. Please go ahead.
Great. Thank you very much. Mark, on wearables in particular, do you think you'll be able to sell enough hardware to recoup your investment, or is that dependent on maybe creating new avenues for revenue from things like advertising services and commerce through that new computing platform? And if so, what are kind of the gating factors there? And then Susan, how do you see the on-balance sheet versus off-balance sheet financing of your AI initiatives? You've recently struck a deal with Blue Owl for the Louisiana data center. Is that part of the CapEx guide for 26? And if it's not, how significant will that way of funding be for Meta going forward? And basically, would that slow down your CapEx growth past 2026? Thank you.
I can talk about wearables, and then Susan can jump in on the other part. So I think that there are a few pieces here. One is that the work that on Ray-Ban Meta and the Oakley Meta products is going very well. I think, yeah, I mean, at some point, if these continue going as well as it has been, then I think it will be a very profitable investment. I think that there's some revenue that we get from basically selling the devices, and then some that will come from additional services and from the AI on top of it. So I think that there's a big opportunity. Certainly, the investment here is not just to kind of build just the device. It's also to build these services on top. Right now, a lot of people get the devices for a range of things that don't even include the AI, even though they like the AI. But I think over time, the AI is going to become the main thing that people are using them for. And I think that that's going to end up having a big business opportunity by itself. But, as products like the Ray-Ban Meta and Oakley Metas are growing, we're also going to keep on investing in things like the more full field of view product form of the Orion prototype that we showed at Connect last year. So those things are obviously earlier in their curve towards getting to being a sustaining business. And our general view is that we want to build these out to reach many hundreds of millions or billions of people. And that's the point at which we think that this is going to be just an extremely profitable business.
Youssef, to your second question, so the JV that we announced with Blue Owl is sort of an example of finding a solution that enabled us to partner with external capital providers to co-develop data centers in a way that gives us long-term optionality in supporting our future capacity needs, just given both the magnitude but also uncertainty of what the the capacity outlook in future years looks like. In terms of how that is recognized as CapEx, our prior CapEx reflected a portion of the data center build cost prior to the joint venture being established. Going forward, the construction costs of the data center will not be recorded in CapEx as the data center is constructed. We will contribute 20% of the remaining construction costs required, which is in line with our ownership stake, and those will be recorded as other investing cash flows.
All right, I'm switching to Google. We got like 30 seconds. Jose, any quick thoughts on what you heard just now?
I think you posted it on Next that they mentioned they feel like they always have enough compute, but it's never enough. And for that reason, and the other thing is they're really focused with AI. They're not focused on creating AGI, right? They're focused on making AI solutions that are going to directly impact their core revenue. So I'd like to hear from that. It's a whole different approach from some of the other AI labs out there.
Sam, any quick thoughts?
I mean, a lot of the questions really were around Reality Labs, as far as the guide down and how much CapEx they're spending, and basically kind of reason with the analysts as far as like why we spending so much money. I did kind of notice for a minute that I think he was like, Mark was trying to say it from a defensive standpoint as to why we're spending this much money, not like an exciting standpoint. It's like, look, we're spending this money because we're really excited for the future. So I think that criticism is actually translated into the price that you see after hours, how it's selling off. Maybe they're not seeing it happen as fast as they expect. I mean, with this, like it really is a bet at this point. I think Meta's margin expansion story was already baked into the price. And now it's like, well, we want more if we're going to keep your stock price up here. So we'll see what Google says. I mean, as far as everything else goes, man, they're all spending more money. So it's always a good thing to see. It's what I want to see right now.
Yep. No, I would agree. I think overall, it looks like things are going in the right direction. It's just that one-time tax fee is what's getting the street upset. By the way, guys, Sam's and Jose's Twitter putting that in the chat and their YouTube, so you can follow them there. And let's get into the Googs.
I'll quickly cover the safe harbor. Some of the statements that we make today regarding our business, operations, and financial performance may be considered forward-looking. Such statements are based on current expectations and assumptions that are subject to a number of risks and uncertainties. Actual results could differ materially. Please refer to our Forms 10-K and 10-Q, including the risk factors. We undertake no obligation to update any forward-looking statement. During this call, we will present both GAAP and non-GAAP financial measures. A reconciliation of non-GAAP to GAAP measures is included in today's earnings press release, which is distributed and available to the public through our investor relations website located at abc.xyz/investor. Our comments will be on year-over-year comparisons unless we state otherwise. And now, I'll turn the call over to Sundar.
Thank you, Jim. Good afternoon, everyone, and thanks for joining us. This was a terrific quarter for Alphabet, driven by double-digit growth across every major part of our business. We are seeing AI now driving real business results across the company. We delivered our first ever $100 billion quarter. 5 years ago, our quarterly revenue was at $50 billion. Our revenue number has doubled since then, and we are firmly in the generative AI era. In parallel, we've built for the long term and diversified with successful businesses in cloud, YouTube, and subscriptions. Our momentum is strong, and we are shipping at speed. As just a few examples, our first-party models like Gemini now process 7 billion tokens per minute via direct API use by our customers. The Gemini app now has over 650 million monthly active users, and queries increased by 3x from Q2. Cloud had another great quarter of accelerating growth with AI revenue as a key driver. Cloud backlog grew 46% quarter over quarter to $155 billion. And we crossed 300 million paid subscriptions, led by growth in Google One and YouTube Premium. Today, I'll discuss progress in our full-stack approach to AI and then share highlights from Search, Cloud, YouTube, and Waymo. As a reminder, our full-stack approach spans AI infrastructure, world-class research, including models and tooling, and our products and platforms that bring AI to people everywhere. First up, AI infrastructure. Our extensive and reliable infrastructure, which powers all of Google's products, is the foundation of our stack and a key differentiator. We are scaling the most advanced chips in our data centers, including GPUs from our partner NVIDIA, as well as our own purpose-built TPUs. And we are the only company providing a wide range of both. As we announced yesterday at NVIDIA GTC, we are now shipping the new A4X Max instances powered by NVIDIA GB300 to our cloud customers. Our highly sought-after TPU portfolio is led by our 7th generation TPU Ironwood, which will be generally available soon. We are investing in TPU capacity to meet the tremendous demand we are seeing from customers and partners, and we are excited that Anthropic recently shared plans to access up to 1 million TPUs. Next, world-class AI research, including models and tooling. Our models are world-leading. Gemini 2.5 Pro, Veo, Genie 3, and our viral sensation Nano Banana are among the very best in class. Over 230 million videos have been generated with Veo 3, and more than 13 million developers have built with our generative models. We are looking forward to the release of Gemini 3 later this year. Our research leadership is advancing next frontier technologies. Last week, we announced that our Willow quantum chip achieved a major breakthrough, running an algorithm 13,000 times faster than one of the world's best supercomputers. And the result is verifiable, paving the way to future practical applications. Speaking of quantum, let me congratulate Michel Devray, our chief scientist for quantum hardware. He received a Nobel in Physics for early research he did in the 1980s. 3 Nobels awarded to current Googlers in 2 years. Incredible. And third, our products and platforms. We are bringing AI to more people and developers than anyone else. In July, we announced that we processed 980 trillion monthly tokens across all our surfaces. We are now processing over 1.3 quadrillion monthly tokens, more than 20x growth in a year. Phenomenal. This quarter, we took big steps to reimagine Chrome as a browser powered by AI through deep integrations with Gemini and AI mode in search, with more agentic capabilities coming soon. In August, at Made by Google, we unveiled our Pixel 10 series of devices. They are the first with our most powerful chip designed to run on Gemini Tensor G5. They are our best reviewed devices ever. And last week, we launched Android XR, our new operating system with Samsung's Galaxy XR device. It brings new ways to use headsets and glasses with Gemini at the core. Now turning to highlights from search. AI is driving an expansionary moment for search. As people learn what they can do with our new AI experiences, they're increasingly coming back to search more. Search and its AI experiences are built to highlight the web, sending billions of clicks to sites every day. During the Q2 call, we shared that overall queries and commercial queries continued to grow year over year. This growth rate increased in Q3, largely driven by our AI investments in search, most notably AI overviews and AI mode. Let me dive into the momentum we are seeing. As we have shared before, AI overviews drive meaningful query growth. This effect was even stronger in Q3 as users continue to learn that Google can answer more of their questions. And it's particularly encouraging to see the effect was more pronounced with younger people. We're also seeing that AI mode is resonating well with users. In the US, we have seen strong and consistent week-over-week growth in usage since launch, and queries doubled over the quarter. Over the last quarter, we rolled out AI mode globally across 40 languages in record time. It now has over 75 million daily active users. And we shipped over 100 improvements to the product in Q3, an incredibly fast pace. Most importantly, AI mode is already driving incremental total query growth for search. Philip will talk more about monetization and share how AI is helping people connect with businesses and shop on search. Next, Google Cloud. Our complete enterprise AI product portfolio is accelerating growth in revenue, operating margins, and backlog. In Q3, customer demand strengthened in 3 ways. 1, we are signing new customers faster. The number of new GCP customers increased by nearly 34% year over year. 2, we are signing larger deals. We have signed more deals over $1 billion through Q3 this year than we did in the previous 2 years combined. Third, we are deepening our relationships. Over 70% of existing Google Cloud customers use our AI products, including Banco BV, Best Buy, and Fair Price Group. As we scale, we are diversifying revenue. Today, 13 product lines are each at an annual run rate over $1 billion. And we are improving operating margin with highly differentiated products built with our own technology. This deep product differentiation starts with our AI infrastructure. We have a decade of experience building AI accelerators and today offer the widest array of chips. This leadership is winning customers like HCA Healthcare, LG AI Research, and Macquarie Bank. And it's why 9 of the top 10 AI labs choose Google Cloud. We are also the only cloud provider offering our own leading generative AI models, including Gemini, Imagine, Veo, Chirp, and Lyria. Adoption is rapidly accelerating. In Q3, revenue from products built on our generative AI models grew more than 200% year over year. Over the past 12 months, nearly 150 Google Cloud customers each processed approximately 1 trillion tokens with our models for a wide range of applications. For example, WPP is creating campaigns with up to 70% efficiency gains. Swarovski has increased email open rates by 17% and accelerated campaign localization by 10 times. Earlier this month, we launched Gemini Enterprise, the new front door for AI in the workplace, and we are seeing strong adoption for agents built on this platform. Our packaged enterprise agents in Gemini Enterprise are optimized for a variety of domains, are highly differentiated, and offer significant out-of-box value to customers. We have already crossed 2 million subscribers across 700 companies. Next, YouTube. In the living room, YouTube has remained #1 in streaming watch time in the US for more than 2 years, according to Nielsen. Last month marked YouTube's first time as a live NFL broadcaster. This exclusive global broadcast, live from Brazil, drew more than 19 million fans and set a new record for most concurrent viewers of a live stream on YouTube. YouTube Shorts also continues to perform well. In the US, Shorts now earn more revenue per watch hour than traditional in-stream on YouTube. At our Made on YouTube event, we rolled out a number of AI-powered features that are helping creators supercharge creation and build their businesses. AI is now streamlining the entire content creation workflow, from generative video tools and more efficient editing to AI-powered insights that help creators optimize their channels. We are also using AI to expand monetization, automatically identifying products to make their videos more shoppable. Philip will discuss in more detail. And finally, Waymo. Next year, Waymo aims to open service in London, and they are working to bring service to Tokyo. They've also announced expansions to Dallas, Nashville, Denver, and Seattle, and secured permission to operate fully autonomously at San Jose and San Francisco airports. Autonomous testing continues to scale in New York City. The new Waymo for Business allows enterprises to offer Waymo as a work travel option. And we launched Waymo Teens accounts in Phoenix this summer. We are pleased to see usage steadily increase with positive feedback from teens and their parents alike. Waymo's growth and momentum are strong, and 2026 is shaping up to be an exciting year. Overall, a milestone quarter. The incredible work of our teams is driving momentum across the board, and our leadership in AI positions us so well for the opportunity ahead. I want to thank all of our partners and our employees for their hard work and an excellent Q3. With that, I'll turn it over to Philip.
Thanks, Sundar. And
all right, this part's going to be boring, but 10 minutes of this and then Q&A.
For the quarter, then structure the rest of my remarks around the great progress we're delivering across search, ads, YouTube, and partnerships. Google Services revenues were $87 billion for the quarter, up 14% year-on-year, driven by accelerated growth in search and YouTube, partially offset by year-on-year decline in network revenues. Adding some further color to our results. The 15% increase in search and other was led by growth across all major verticals, with the largest contributions from retail and financial services. YouTube saw similar performance across verticals. Its 15% growth in advertising revenues was driven by direct response, followed by brand. Starting with search and other revenues, which delivered over $56 billion in revenue for the quarter. As Sundar mentioned, AI is driving an expansionary moment and transforming how people use Google Search. Our investments in new AI experiences, such as AI overviews and AI mode, continue to drive growth in overall queries, including commercial queries, creating more opportunities for monetization. These AI experiences are enhancing how people connect with businesses and shop on search. We recently added shopping capabilities in AI mode, which now help people shop conversationally in search, and we expanded try-on capabilities to more clothing items, now available to anyone in the US. Lastly, we're making it easier for consumers to benefit from deals through new loyalty offerings like personalized annotations on organic results and ads. Looking at monetization, businesses can now tap into our most powerful AI search experiences. Using our most advanced AI models, we can understand and predict intent like never before, unlocking entirely new commercial pathways to provide valuable new consumer connections and helping us monetize even more efficiently. Rolled out globally in September, AI Max in search is already used by hundreds of thousands of advertisers, currently making it the fastest growing AI-powered search ads product. In Q3 alone, AI Max unlocked billions of net new queries. By delivering the most relevant ad across surfaces and matching advertisers against additional queries they weren't reaching before, AI Max helps advertisers discover new customers at the exact moment they need their product or service. Kayak, for example, looked to grow conversions while staying within their ROAS goals. After turning on AI Max in search, they grew the conversion value by 12% in early tests. We continue to infuse generative AI capabilities at every step of the marketing process. We rolled out Imagen 4 in Asset Studio and Product Studio, helping businesses produce more and better creatives. On the measurement front, we enriched the model supporting Meridian, our marketing mix model, with additional variables. And more granular reporting in PMax is making bidding more effective. Financial services company SoFi has been using PMax to meet its ambitious growth targets and help drive a 39% improvement in its conversion volume year over year. Moving to YouTube, where we saw accelerated revenue growth, our recommendation systems are driving robust watch time growth in our key monetization areas like Shorts and Living Room. As we leverage Gemini models, we're seeing further discovery improvement. On direct response, we're excited about the growth in revenue we're seeing, especially from small and medium advertisers adopting Demand Gen. We also improved performance on Demand Gen, with over 100 launches helping to increase conversion value by more than 40% for advertisers using target-based bidding on YouTube. The retail vertical continues to lead our growth on YouTube, with Demand Gen helping us further monetize shopping-related categories. Looking at the living room, our long-term bet more advertisers are adopting interactive direct response ads, leading to an annual revenue run rate exceeding $1 billion globally for this format. For our viewers, we continue to give fans greater access across sports while tapping into the best of YouTube's product innovation and creator-led content. Sundar mentioned that we expanded our NFL partnership with our first ever exclusive global broadcast of an NFL game. Brands loved the opportunity, and we sold all our ad inventory within a couple of weeks. Looking at creators, a significant force behind the thriving YouTube creator economy is the collaboration between creators and brands. Tools like direct linking to deals, websites, and Shorts and swappable brand segments in long form will soon help creators show how they deliver great value for brands. Thanks to a collaboration with Dude Perfect, Comcast Xfinity drove an 8% search lift, beating other Xfinity ads' recall lift on Shorts by 34%. At the same time, it decreased the cost per lifted user by 50% when compared to the next most efficient ad. We continue to invest in AI-powered features that are helping creators supercharge creation and build their businesses. With VO3 integration and speech-to-song, creators go from idea to iteration quicker, and new channel insights help them better understand performance. Ending on YouTube with our subscriptions products, we're also seeing momentum with strong growth in offerings such as YouTube Music and Premium and YouTube TV. We're also applying Gemini internally to help us serve customers with increased speed, intelligence, and efficiency. Our sales teams use Gemini enriched with ads knowledge to streamline customer interactions. This increased productivity by over 10%, led to hundreds of millions in incremental revenue, and frees up sellers to engage with more customers at a deeper, more strategic level. In our customer support division, Gemini-powered solutions have managed over 40 million customer sessions so far this year and resolved hundreds of thousands of customer inquiries, and we're just getting started. As always, I'll wrap with the progress we're seeing across partnerships where customers tap into the strength and breadth of Google's products to accelerate their transformation. Revolut, the global financial services company, leverages Google Cloud's Vertex AI platform and Gemini models to help power its advanced customer service chatbot, develop new hyper-personalized financial products, and offer predictive insights. Revolut is also increasing its presence on YouTube, adopting VO3 for personalized creatives, making Google a key ads partner for delivering growth and launching new markets. In closing, I'd like to thank Googlers everywhere for their contributions to our success, and as always, to our customers and partners for their continued trust. And, of course, a huge thanks to all of you as we celebrate 25 years of Google Ads. Anat, over to you.
Thank you, Philip. My comments will focus on year-over-year comparisons for the third quarter, unless I state otherwise. I will start with results at the Alphabet level and will then cover our segment results. I'll end with some commentary on our outlook for the fourth quarter of 2025. We had an outstanding quarter in Q3, continuing the strong momentum we've had throughout the year, delivering double-digit revenue growth across search and YouTube advertising, subscriptions, platforms and devices, and Google Cloud. Consolidated revenue reached $102.3 billion, a 16% year-over-year increase, or 15% in constant currency. Total cost of revenue was $41.4 billion, up 13%. Tech was $14.9 billion, up 8%. Other cost of revenues was $26.5 billion, up 16%, with the increase primarily driven by content acquisition cost, largely for YouTube, followed by depreciation and other technical infrastructure operations cost. Total operating expenses increased 28% to $29.7 billion. R&D expenses increased by 22%, driven by compensation and depreciation expenses related to our AI efforts. Sales and marketing expenses were flat, and G&A expenses increased meaningfully, primarily due to the $3.5 billion charge related to the European Commission fine mentioned in the earnings press release. Operating income increased 9% this quarter to $31.2 billion, and operating margin was 30.5%. Excluding the EC fine, operating income increased 22%, and operating margin was 33.9%. Operating margin benefited from strong revenue growth and continued efficiencies in our expense base, offset by the legal charge and a significant increase in depreciation expense. Other income and expenses was $12.8 billion, primarily due to unrealized gains in our non-marketable equity securities portfolio. Net income increased 33% to $35 billion, and earnings per share increased 35% to $2.87. We generate free cash flow of $24.5 billion in the third quarter and $73.6 billion for the trailing 12 months. Free cash flow in Q3 benefited from strong operating cash flow and recent tax changes regarding the timing of when research and development costs are expensed and assets are depreciated. This was partially offset by higher CapEx. We ended the quarter with $98.5 billion in cash and marketable securities. Turning to segment results, Google Services revenues increased 14% to $87.1 billion, reflecting strength in Google Search, YouTube advertising, and subscriptions. Google Search and other advertising revenues increased by 15% to $56.6 billion, representing another robust quarter with continued growth across all major verticals, with the largest contributions from retail and financial services. YouTube advertising revenues increased 15% to $10.3 billion, driven by direct response advertising, followed by brand. Network advertising revenues of $7.4 billion were down 3%. Subscriptions, platforms, and devices revenues increased 21% this quarter to $12.9 billion, driven by very strong growth in both YouTube and Google One subscriptions. Google Services operating income increased 9% to $33.5 billion. Operating margin declined year-over-year to 38.5%, as healthy revenue growth and continued efficiencies in our expense base were offset by the impact of the EC fine, which was fully reflected in the Google Services segment. Turning to the Google Cloud segment, which again delivered very strong results this quarter, as Cloud continued to benefit from our enterprise AI-optimized stack, including our own custom TPUs and our industry-leading AI models. Cloud revenue increased by 34% to $15.2 billion in the third quarter, driven by strong performance in GCP, which continued to grow at a rate that was much higher than Cloud's overall revenue growth rate. GCP's growth was driven by enterprise AI products, which are generating billions in quarterly revenue. We had strong growth in enterprise AI infrastructure and enterprise AI solutions, which benefited from demand for our industry-leading models, including Gemini 2.5. Core GCP was also a meaningful contributor to growth. And we had double-digit growth in Workspace, which was driven by an increase in average revenues per seat and the number of seats. Cloud operating income increased by 85% to $3.6 billion, and operating margin increased from 17.1% in the third quarter last year to 23.7% this quarter. The expansion in Cloud operating margin was driven by strong revenue performance and continued efficiencies in our expense base, partially offset by higher technical infrastructure usage cost, which includes depreciation expense and other operations costs such as energy. Google Cloud's backlog increased 46% sequentially and 82% year-over-year, reaching $155 billion at the end of the third quarter. The increase was driven primarily by strong demand for enterprise AI. As Sundar mentioned earlier, Cloud has signed more billion-dollar deals in the first 9 months of 2025 than in the past 2 years combined. In other bets, revenues were $344 million, and operating loss was $1.4 billion in the third quarter. Within other bets, we continue to allocate more resources to businesses like Waymo, where we see opportunities to create substantial value. With respect to CapEx, in the third quarter, our CapEx was $24 billion. The vast majority of our CapEx was invested in technical infrastructure, with approximately 60% of that investment in servers and 40% in data centers and networking equipment. In Q3, we returned capital to shareholders through repurchases of stock of $11.5 billion and dividend payments of $2.5 billion. Turning to our outlook, I would like to provide some commentary on factors that will impact our business performance in the fourth quarter of 2025, as well as an updated outlook for CapEx for the year. First, in terms of revenues, we're pleased with the overall momentum of our business. At the current spot rates, we could see an FX tailwind to our revenues in Q4. However, the volatility in exchange rates could affect the impact of FX on Q4 revenues. As for our segments, in Google Services, year-over-year comparisons in advertising will be negatively impacted by the strong spend on U.S. elections in the fourth quarter of 2024, particularly on YouTube. In Cloud, demand for our products remains high, as evidenced by the accelerating revenue growth and the $49 billion sequential increase in Cloud backlog in Q3. In GCP, we see strong demand for enterprise AI infrastructure, including TPUs and GPUs, enterprise AI solutions driven by demand for Gemini 2.5 and our other AI models, and core GCP infrastructure and other services, such as cybersecurity and data analytics. As I've mentioned on previous earnings calls, while we have been working hard to increase capacity and have improved the pace of server deployments and data center construction, we still expect to remain in a tight demand-supply environment in Q4 and 2026. Moving to investments, we're continuing to invest aggressively